Okay, I think it's 5:30. Let's get started. Welcome, everyone. Thank you for joining me today for our live stream seminar about tax strategies and tax saving opportunities in real estate transactions and ownership. We're also streaming live on Facebook, YouTube, 一直播, Weibo, and TikTok. Today, we're going to be speaking with a CPA and a 1031 exchange specialist about how critical it is to understand the tax implications of real estate transactions. Hi, my name is Coco Tan. I'm a realtor with Keller Williams Realty in the San Francisco Bay Area. If you wish to receive the latest videos and seminar updates, please feel free to subscribe to my YouTube channel. I have a big QR code right here on my wall. Today's topic is tax strategies and tax savings.
I think she froze. Everyone else is still there, right?
Yeah. Coco can't hear you.
Cannot hear Coco.
In real estate. Today, we will cover the issues of taxes in real estate transactions. During the process of me helping my clients in buying or selling real estate, the question of taxes always come up. Although I'm an experienced realtor, I'm not a tax professional. So I always say, please refer this question to your CPA or tax professional. Very fortunately, today I have invited two notable and distinguished professionals to discuss the topic of taxes in regards to real estate. I am very excited to introduce to you my special two guests for today. Each of them can give us some very valuable insight on how to maximize your real estate investment profit. My first guest is Mr. Bin Zhai, a certified public accountant and a certified financial planner who has spent over 20 years helping high net worth individuals and business with financial planning. Mr. Zhai specializes in tax planning and preparation in individual, as well as small business accounting. Can you all mute for now? Because I hear some background noises here. Yeah. Okay, so let me continue. So Mr. Bin Zhai started his career in public accounting firms like Moeller, Nixon, and Williams, one of the 5th biggest accounting firms in Silicon Valley. Mr. Bin Zhai received his bachelor's degree in accounting in 1989 from Shanghai University of Finance and Economics in China, and earned an MBA degree in concentration in accountancy from California State University, Fulton in 1993. Welcome, Bin.
Thank you.
Thank you for joining us today. So let's start from the very basics then. When someone sells a property and makes a profit, what is the tax liability for selling a home?
Okay, so can I share the slide with you guys? Can you see it? Okay, so normally when you sell a real estate, you end up have, depends on you have a primary home or if it's a rental home. If it's a primary home, everyone gets $250,000 exemption as a single. For a couple, it's about $500,000. The condition is if you live there 2 years out of 5 years, right before you sell. Can you hear me well, Coco?
I can hear you okay.
Okay,
is
great.
it okay?
Okay.
Let me see. You can continue with your slide. I guess I am trying to. Okay, here we go. Yeah, okay, so.
The slide too small?
No, I can see it. It's okay. It's good.
Okay.
Okay, so if it's a primary home, there is capital gain exemption.
Yes.
So it's 250,000 for individual or 500,000 exemption for if you have 2 years stay within the past 5 years.
Yes.
But the rental home, that tax rate applies.
Rental home are different. There's so many different rate, California rate and the federal rate. I just make this simple, okay? So it depends on your income. If your income is under 600,000 under the highest rate of a income tax bracket, you pay about 1/4 of the net capital gain. If you're over 600,000, you could touch the highest tax rate, which is only 37 federal rate. So combine the federal, California, and the net investment tax, which is Obamacare tax 3.8, it equal well over 1/3 of your net earnings. So if you sell your rental property, the tax rate could be as high as 1/3 of what you earned. Government gonna take out almost 1/3. So
Okay.
if your tax rate is lower than the highest rate on the income tax, your capital the tax combined federal and the California, it's about around 24 to 25%. You know.
Okay. So how do we legitimately lower our taxable gains so that we can pay less in taxes legally?
Well, normally each person will get the deduction when they have their house, if it's a primary. So you either get a $1 million mortgage deduction up to 1 million or 750. Depends on the cutoff day when they pass the tax reform, which is a Trump tax reform in the end of 2019. So December 15 is a exactly cutoff. So normally you get help on your house deduction. In the Bay Area, the mortgage are very high. A lot of our client is over 1 million or 750. That's why they got that deduction. But your question is how I legitimately lower my tax rate.
Taxable gains so that we can pay less in taxes,
so,
yeah. Mm-hmm.
So how do you calculate the net capital gain? It really depends on how much the cost base you have. So you need to calculate correct cost base. There's several things can increase your cost base. Not only the acquisition cost when you originally purchased the house, but also any improvement cost incurred after purchase, such as remodeling, improvement, fix-up, new appliance, fixture, and the furniture. They all can increase the value of your adjusted base. And also when you have when you're closing the house, don't forget that at the selling time and the buying time, the HUD report will show the closing cost. Now, those are the costs on the top of the charge of the stated value, either you buy or you sell. So when you sell, you should deduct those closing costs from your selling price. So those include the commission cost, title insurance, document fee, the property. There is some small things called in the property tax. A lot of people in California, they won't be able to deduct the property tax, but there's one line item called a special assessment. They can be found out every year. You can including the special assessment on the property tax and including into the adjusted cost to increase your overall cost. And also, if you do several, if you do a refinance, the last time you do the refinance, if you pay any cost or any points, those amortized costs can also be included in your adjusted base. So overall, you need to do a lot of work, you know. But the one thing I should tell you, if you use your house for your home office or the rental property during the life of the cost, all those depreciation will be recaptured as a cost of recovery. That in the tax sense means they will be taxable, okay?
So really you have to keep very good records, and then especially for people who live in that house for a long time, keep good records. Yes. And really make sure you have your cost base right. Yeah.
Sometimes you need to go back 10 to 20 years to find out what did you pay. You know? Okay.
Yeah, so some of you participated in our last seminar where my finance professor, Bob Johnston, built a financial model and showed us how to calculate the ROI for investment properties. I'm not sure if you paid attention to a detail about taking tax deduction from the rental losses. So I wish to check with our CPA here does the rental tax deduction happens automatically for all the losses, or do you need to qualify in order to write off rental losses? And if so, is there a maximum amount that is allowed to be written off on rental losses?
Yeah, that's a good topic. So my next slide shows what's required to get the, when you have a rental property, you will receive a tax deduction, but not all the people will be qualified those, particularly in the Bay Area over here. Normally, IRS classify the rental activity as the passive activity. Normally, if you don't spend 50% of your time or 50% of income coming from rental activity, all the rental, they don't require too much time involvement. So IRS will classify them as a passive activity. The rule in the passive activity is if you have a net gain, they are taxable. If you have a net loss, they may be or may not be tax deductible. So we examine the case depends on the AGI, okay? So if your AGI is under $100,000, you will get a $25,000 deduction if you actively manage it, but it's still a passive loss. So if your AGI is, AGI stands for adjusted gross income, normally the total income for your household. So if your AGI over $100,000, every dollar over will do the 50% phase out. So when your AGI over 150K and all the loss, which up to $25,000 will be phased out. So a lot of engineer family in Bay Area, although they have a rental house, and if they suffer the loss, they probably won't be able to get the deduction because their AGI is way higher than 150.
Got it. Oh, yeah. So also from last seminar, you may also have noticed that there is a formula built into the financial model to write off depreciation, which is the non-cash expense to help reduce income tax. So can you help elaborate how the depreciation works? For example, how many years for what kind of assets, etc.?
Yeah, so I pull out one of a chart for IRS publication 527. If you have time, you can take a look over there. My chart over here are very small. So if I can blow it a little bit, can you see the blow now?
Yes.
Still very, very small. So basically, IRS categorize the in the residential property. They have a 5-year depreciation assets and equipment, and they're the 7 years. For instance, over here, refrigerator are the 5-year depreciation. Carpet are 5-year. Furniture used in the rental are for 5 years, and you have a deck and the files are 7 years. So IRS went to very much lengths to define everything, you know. And also they defined that the fence are 7 years, the butchery is the 15 years. The fence are 15 years, roads are 15 years. So you should follow those IRS table when you prepare the tax return, define 5 or 7 years. So that means you only can take, if there are 5 years, if you use a street line method, 1/5 is only 20% are deductible, okay? But during the tax reform in 2017, the tax law allows to have a very quick depreciation, which called bonus depreciation. So let me find that slide over here. Which is after 2017 tax reform, IRS allow bonus depreciation. That means 100% expensing for certain business assets in the category for 5 or 7 years in the first year of a service. So
you can write off the whole thing in the first year.
Yeah, you can write the whole thing off. Most of those assets should define in 5 or 7 years assets. So mainly like equipment, furniture, fixture, appliance. If you purchase those after 2017, you can quickly depreciate them very quick.
That's great, yeah. So for rental losses, we have tax deductions. And for rental income, can we have some sort of income exemption to save taxes?
Yeah, I prepared a slide over here. So for the rental income, also after 2017 tax reform, IRS introduced a new tax deduction, which is called, that can benefit the rental property. That it is a 20% net income exemption, can be offset from your overall income if one can meet the following three, they call the safe harbor rules. So, so those safe harbor rules for some people are very easy to meet the conditions. Some probably very hard, but if you understand them, maybe you can adjust your practice. You can qualify those too. So basically, they just want you to keep all the documents you have on the rental. So for each rental, you should clearly document how much income and the expense you have. And you need to prove 250-hour rental service being performed for your rental. Those service doesn't have to perform by you, can perform by your rental manager, the serviceman, the cleaner, the landscaper, you know, if they can document time for 250 hours, it will count as a safe harbor. And the taxpayer should maintain the records, very good record for the time reported, and such like a time log, etc. Okay.
Okay.
And we also think the taxpayer should attach a statement when they file a tax return. They will pursue IRS code 199 cap 8 deduction, the whole exemption. If you qualify for 20%, you should prepare a statement to document, to tell IRS, I don't want to pay the 20% income I earned from my rental.
Okay, that sounds good. Thank you, Mr. Zhai. This is very informative and very useful information. Sure. I see our audience already have a lot of questions for you. Let's save the questions for the Q&A session, and sure, please keep sending your questions over. And make sure you stick around and get your questions answered. Right. Our second guest today is going to be speaking about a very popular topic among real estate investors, the 1031 exchange. Joining us now is James Callejas, Vice President of National Accounts with Investment Property Exchange Services, Inc. James is responsible for business cultivation development nationwide. James has over 20 years of experience in the 1031 exchange industry. James has conducted thousands of seminars on different topics related to real estate, tax, estate planning, and personal property. He teaches continuing legal education and continuing professional education to attorneys and CPAs. Additionally, James is often asked to speak at real estate forums for commercial brokers, agents, wealth managers, principals, and other assorted real estate professionals. James currently resides in Walnut Creek and received his BA from UC Berkeley. Welcome, James.
Good afternoon. Happy to be here, Coco. Thanks for the invite.
Thank you. So let's start from the basics as well. Maybe we can start with, what is the definition of a 1031 exchange?
Well, if you look it up in the dictionary, they're going to give you a very intricate sentence. I like to simplify everything. And I think when I hear 1031 exchange, and when anybody hear 1031 exchange, it's basically where you are selling investment property and looking to buy investment property. And if you do it correctly and follow the guidelines that we're going to go over today, you'll be in a position to pay zero in capital gains tax.
Oh, wow. So I guess my next question, why do the investor do it? But they already answered that question. I guess, do you have some other motivating factors for doing 1031 exchange?
You know, it's funny that you say that, Coco, saying that I already answered the question about not paying capital gains tax. That's the #1 answer I receive on why people do 1031 exchanges. But I actually don't think that is the correct answer. If you don't want to pay the tax, there's a very simple strategy. Do not sell the property. You will not pay taxes. So people do 1031 exchanges for other reasons. For example, my parents bought property in San Francisco in the early 70s for about $50,000. And it's a 3-unit building in the Noe Valley area of San Francisco. And today it's worth over $3 million. And they think this is an excellent piece of investment property. And the reality is this is actually a very bad piece of investment property. We own investment property for 4 different reasons: appreciation, cash flow, depreciation, and amortization. And if we look at that property right now, they're subject to rent control. They're making probably about $4,000 a month take home, which is about $48,000 a year. This is very poor cash flow. Second reason we own investment property is depreciation. Like we saw on Ben's slide, on residential property, because this is 3 units, it's residential property. At maximum, you can depreciate this property for only 27.5 years. That write-off, and by the way, that's only on the original purchase price minus the value of the land, that write-off is exhausted. It's done. So poor cash flow, no depreciation left. Third reason we own the property, investment property, is amortization, where you pay down the loan and build up equity. This property is free and clear. There is no more amortization left on that property. Fourth reason we own investment property is appreciation. They absolutely did so well in this aspect of owning the real estate, but at some point with massive appreciation, the return on the investment no longer makes sense. What you consider a cash cow is actually a poor return on investment. This is the perfect opportunity to unload a property. And by the way, my parents are in their 70s and they still manage this property. They're tired of the tenants, the trash, the toilets, the termites, the taxes, all the terrible T's. If I tell you that you could sell this investment property, quadruple their income, and get out of managing the terrible T's and preserve everything, and maybe even get a new depreciation schedule, now we're talking. This is why people do 1031 exchanges, whether it's to get out of active management, whether it's to leave the state of California where we are subject to rent control and other ordinances, whether it's to diversify your real estate portfolio and buy multiple investment properties. Maybe it's to go from residential to commercial property. Maybe it's to buy that dream home that you eventually want to move into, or that vacation home in Hawaii, in Lake Tahoe, in different areas. All of this can happen in a 1031 exchange. So when people ask me, why do you do a 1031 exchange? There are so many reasons why somebody does a 1031 exchange. The first question I come up with is, what don't you like about your current investment property, and where are you looking to go in life right now? And if it's more cash flow, I can tell you where to go. If it's to get the dream home, I can tell you how you can make that happen. If it's a change product type, I can make that happen as well. So motivation, reasons why, there are so many, Coco.
That sounds exciting. So tell us, what are the requirements in order to be qualified to be the like kind so that we can do the exchange?
I think that's a great question, because I think so many people out there say, I'm going to do a like kind exchange. And when they hear like kind, they think, okay, so I sold a single family home that's a rental. Now I need to buy a single family home that's a rental. And that's the big misconception out there. It's really easy. All you have to do is ask 3 questions. Is it real property? Is it used for a business or investment purpose? And is it in the United States? If you can answer yes to all 3, then it's like kind. So basically, I could sell that single family residence and buy a farm. I could buy a vineyard. I could buy a commercial property. I could buy a bunch of condos that I rent out, townhouses that I rent out. I could actually buy a fractional interest in a large commercial institutional property. There are so many different things that you can do in a 1031 exchange. So when you think like kind, real property, business or investment purpose in the United States.
Wow. So why don't you give us some examples of that's not the like kind excluded properties?
I'm just going to give you 3 because these are the most popular. There's a few others, but you're not going to see it that often. Number 1, the primary residence doesn't qualify for a 1031 exchange. And I think Ben explained that earlier. If you've lived in the property 2 out of the last 5 years, if you're single, $250 if the gain is tax-free. If you're married, $500,000 if the gain is tax-free. But the primary residence does not qualify for a 1031 exchange. However, be very careful on this one. A mixed-use property, like the farm. I live on the farm. There's a primary residence, but the farm is investment property. I can do both. Or in the Sunset District of San Francisco, where I grew up, there are so many properties out there that have in-laws and they rent those in-laws. I can get the $250, $500 on the primary portion, and I can 1031 exchange the in-law. So the primary doesn't qualify, but if it's mixed use of some sort, whether you're renting out rooms, it's a casita, an ADU, an in-law, you're running a business there, that qualifies that portion. So the primary doesn't qualify. The second home does not qualify. By the way, the second home qualifies for absolutely nothing but paying taxes. There are ways to make second homes investment property, but a second home does not qualify, and a flipper property does not qualify. So if I buy it, I fix it, and I look to sell it, that has not been operated or held for a business or investment purpose. That is just being turned and burned and considered resale property. That does not qualify for a 1031 exchange as well.
Yeah, I often hear that question as well. Yeah, thank you.
And
So
most people, Coco, ask me, how long do I have to actually treat it as investment property to qualify? There is no black and white. You'd ask someone like Ben to answer the question. I've seen it done very quickly. Usually it's 1 to 2 years unless there is an extraordinary circumstance.
Right. Yeah, so that's a very good point, because a lot of people think, do I just have it on my tax reporting before I can use that as a 1031 exchange? And then the answer, I guess, is really depends on the situation then, right?
It really depends on the situation. I could still tell you stories all night. We don't have time for that, but there are so many scenarios where I've seen it done very quickly in less than a year. But if there is no extraordinary circumstance, you're probably going to wait 1 to 2 years.
Oh, tell me about the Hawaii story. I think I heard it one time.
Yeah, so I had a client that sold a piece of property in Clayton, California for $750,000. He bought a replacement property in Maui for $1 million. And he put it in the Maui Times for rent, Craigslist for rent, had a big for rent sign out there right in front of the property. And he got so many different calls, people looking to rent the property. Then he got one call and the guy goes, you know what? I don't want to rent the property. I want to buy it. And I'm going to give you $2 million for it. And the client was so excited, he called me up and he goes, James, can I do a 1031 exchange? I know I've only owned it for 2 weeks, but this guy's going to give me $1 million more than what I paid for it. And I told him, I go, well, what happened? And he gave me the story. I go, well, I would absolutely do a 1031 exchange because this is an unsolicited, unforeseen business opportunity. I want to get your tax advisor on the phone, but it seems like this is something where your intent was to hold it as investment property, but a unique scenario came up. You made $1 million in 2 weeks, and now you're going to exchange it into other investment property. And most tax advisors would recommend that they move forward as long as the intent, because it's all about intent, was to keep it as investment property. Something unique definitely happened for this client, and he was as happy as a clam.
Wow, this is exciting. We all wish we can make $1 million in 2 weeks.
Doesn't
and
happen that
without
often.
paying the taxes also. Yeah. So tell us, what taxes am I able to defer in the 1031 exchange?
I think Ben covered the majority of that, but in a 1031 exchange, you're going to get hit in 4 possible sectors: federal tax, state tax, healthcare contribution, and depreciation recapture. Recapture is just a flat rate of 25%. The state will fluctuate anywhere between 9.3 to 13.3%. The feds will either be 15 or 20. And by the way, those are in different tiers based on adjusted gross income. So it may start at 9.3, it may end at 13.3. Federal tax may start at 15, it may end at 20. If you make absolutely no money, it may even start lower than that. And then for the healthcare, once you hit a certain number, 200,000 in adjusted gross income per year if you're single, or 250 for a married couple, they're going to tack on 3.8%. I'd say the average in California is about 30% on the gain, but it could go a little bit lower. Usually in the Bay Area, it goes a lot higher.
Oh, okay. Wow. Okay. So can you also please help go over some very basic rules for a 1031 exchange? Any restriction we're looking out for, anything that we need to look out for?
Yeah, well, first off, it has to be investment property. We've covered that, but I want to make sure everybody understands this is only for investment property. I think in order to be in a position to defer all capital gains tax, you want to make sure all of the money from the sale goes into the 1031 exchange account and goes towards the replacement property. Some people think that their original deposit to buy the property comes back to them. It doesn't. I don't agree with it, but nobody cares what James thinks. They only follow what the IRS says. So, original deposit money or just the gain money, that's not how it works. Everything needs to go into the 1031 exchange account. All the cash needs to be used towards the purchase property, and any loans that were paid off on the property that was being sold needs to be replaced with either a new loan or new debt to be in a position to pay 0 in capital gains tax. But sometimes people say, you know what, I'm going to buy a little bit less in value and I'm okay with paying a little bit of tax because my cost basis is very low. So if I buy down a little bit, I'm just going to pay a little bit in tax, but I'm going to save a lot on not paying all of the taxes. So I want to make sure that everybody understands, to be in a position to pay zero in capital gains tax, all of the proceeds must be used and all of the debt must be replaced with either new debt or cash.
Okay, sounds good. So tell us about the timeline for a very common 1031 exchange.
So here's how it would work. I look to sell my investment property for some of the reasons that I mentioned earlier. I contact Coco and say, please list this property. I need to end this nightmare and to get into something different. You list the property, you get an offer, you accept an offer, you open up escrow, then the 1031 exchange account should be opened. This must be done prior to the close of escrow. We then put together our legal documents that allow us to assign into the rights of the contract, so we can essentially become the seller. If the seller is the seller, that means they get money at the close of escrow. That can't happen, because then they'll have constructive receipt and be subject to capital gains tax. So we assign into the rights, we become the seller, and at the close of escrow, the proceeds go into the 1031 exchange account. And then the fund starts. The clock starts ticking at that point. You have 45 days to identify potential replacement property and 180 days to close on it. And again, as long as you use all the proceeds and buy of equal or greater value, you'll be in a position to pay zero in capital gains tax. I'd like to add that the 1031 exchange is not something where, oh, let's list the property and we'll just figure it out. I would probably not list the property unless I have an exit strategy in mind, because 45 days goes very quickly. I would want to have lined up what I'm looking to buy ahead of time and have a plan A, B, and C to execute just in case.
That's a good point. And also, what is the identification rule? You have to identify 3 properties. So is that the 3 property, the identification? Do you have any rule for that?
You choose from one of 3 rules. And basically, there's only 2 rules that you're probably going to be using, but I'll mention the third as well. The first and most popular rule is the 3 property rule. This rule says that you can identify up to 3 properties of any value. You don't have to identify 3. That's just the max using this rule. And there is no limit on the value. It could be $5. It could be 500 billion. That is up to the client. Now, if I'm selling out here in the Bay Area, and let's say I sell something for $1 million and I'm looking to go to a different state. I had somebody buy condos in Buffalo for $30,000 a pop and bought so many because they sold out here for so much more money. If that is the case, this 3 property rule is not going to work for you. Then you would use the second rule. The second rule is the 200% rule. And the way it works is you look at the gross sales price of the property being sold. In this example, it's $1 million. 200% of $1 million is $2 million. That means I can identify $2 million worth of real estate. That's a lot more than 3 properties when you're identifying smaller properties. So in my opinion, if you're looking to buy the big property, maybe 1 or 2, you're going to use the 3 property rule. If you're looking to diversify and buy a lot of smaller properties, then you're going to use the 200% rule. And if you're a gambler, then you're going to use the 3rd rule, and that's the 95% exception. And the reason why I call it a gambling rule is because here's how it rolls out. You can identify as many as you want, and it doesn't matter what the value is, but you have to close on 95% of the value that you identify. And if you don't, the entire exchange fails. Basically, you have to make sure everything closes, or else the entire exchange is going to fail and you're going to pay a lot of capital gains taxes. This is rarely used. In my 22 years in the business, I've done over 50,000 exchanges, and I've seen it work probably about 13 times.
Wow. So exit strategy is very important. But let's see, we have a seller's market right now in the Bay Area. Investors often worry about not being able to find a good replacement property on time within the required time frame. What would be your suggestion? Do you have any alternatives to do this?
Yeah, I think it is very popular, in particular in the Bay Area. The reverse exchange is something that can get rid of that 45-day identification period. And I think it is a great exit strategy when you're looking to buy that perfect asset. Now, it might even be the dream home that you eventually want to move into, right? You don't want to take a chance of buying something that you're not going to like, and you want to make sure you get exactly what you're looking for. So the reverse exchange is where you buy first and sell second. Now, most people come to me afterwards saying, well, that's what I want to do. And I let them know it's not that easy. That's why everyone does not do that. First off, you have not sold a property, so where are you going to get the money to buy this property? We are not going to buy it for you. So if you have the cash to buy it, it's very easy. If you need to get financing, it may be a little bit more challenging. Here's how it would roll out. You would get into contract to buy a property. We, as the exchange company, again, would create our legal documents and assign into the contract, but this time it would be a little bit different. We would also set up a special purpose entity, which is a single member LLC that will go on title to the property at the close of escrow so that the client does not own both properties at the same time. Now, if you're buying all cash, this is very easy. If there is a lender involved, and most conventional lenders for residential property will not lend to an LLC, this will be more challenging, and you will have to probably bring in a private money lender to get this reverse exchange to go through. So I think it is a great strategy for the right person. We'd have to have a more in-depth conversation, but if you do not have the money to buy the property without the sale of the first property, it could be very challenging.
Okay, that's great. So can you also give us a very quick overview of the other kinds of exchange, like delayed improvement exchange or bill to suit exchange? I heard all those,
You're going to hear stalker exchange, delayed exchange, simultaneous exchange, 1031 exchange. All of those just are a regular forward delayed exchange, meaning that you're selling first and buying second, whether it's immediately afterwards or within those 45, 180-day timeframes. We went over the reverse exchange where you buy first and sell second. But there is one last exchange I would like to mention because I get this question a lot. And the question is, okay, James, I sold for $1 million, but I found the perfect property for $800,000, but it needs a lot of work. Can I use the exchange money to improve the property? And I let them know there is a way to get this done, but it is very challenging. And here's the reason why. Number one, improvements do not qualify. Remember, I told you it has to be real property, but there is a way around this. The first route is to ask the seller to do the improvements, which would increase the sales price. And as long as those improvements are done by the close of escrow, it works. But what seller is going to do $200,000 worth of improvements? You're not going to find that. The second way is an improvement exchange. Since improvements do not qualify, again, the exchange company would set up an LLC. The LLC would go on title at the close, and then those improvements must be identified within the 45-day period and must be completed within the 180-day period. The challenge is, how do I get something like that done in areas where there's so many different permits and things that are required? And if I can't get it done within the 180 days, it won't work for me. So if somebody were to say, I'm going to do this in San Francisco, I'd say, it's just not going to happen. But in some areas, it really is powerful that I can use some of the money to improve the property that I want, and I get to the target price and not pay any capital gains tax.
Oh, that sounds great. So my last but not least question, who can be qualified intermediary for 1031 exchange?
I'm glad you asked that question, Coco. The answer is almost anybody can be a qualified intermediary. It's an unregulated industry. The only people that can't be a qualified intermediary, and by the way, a qualified intermediary is what I do, the exchange company. The only people that can't be a qualified intermediary are related parties. So mom, dad, brother, sister, grandparents, grandchildren. Those people can't be your qualified intermediary. Your tax advisor, your real estate agent, or your attorney that you've employed the last 2 years, they can't be, but pretty much everybody else can be. But you just don't want to use anybody else. Number one, they're not going to have the means to produce the legal documents. And if you were to hire an outside attorney, they're going to charge significantly higher and may not have all of the language. In particular, with extensions that come out for the 45 and 180-day period, an attorney that just does it for the first time is not going to have the right language that will allow that extension to occur, like the one we had for COVID-19. And more importantly, somebody out there is not going to just be able to hold your money, put it in the right account, and keep it secure. You want to make sure that you use a financially stable company that has a huge parent company with the right bonding and assurances to make sure that the money is safe. Because no matter how much the person knows, if the money isn't safe, it doesn't help you at all. You'll lose the money and still have to pay tax.
You don't want them to run away with all your big amount of money. You just sold the property for, yeah.
You don't want that to happen.
Right. This is very valuable information. Thank you so much, James, for sharing.
My pleasure.
So we have been streaming on Facebook, YouTube, and other platforms today, and we have compiled some questions from our viewers for our guests. Before we get into the question and answer session, I would like to give you a very quick preview of our next series of seminars. Buyers, are you ready? So I will have a home inspector and a natural hazard disclosure representative talk about what is a natural hazard disclosure report, how to understand it, how to prepare yourself for your home inspection, and how to ask the questions so you can better understand the condition of the home. Annette from JCP, please give us a sneak peek of what you will be covering. Annette.
Thank you so much, Coco. Hi, everybody. Good evening. Okay, so I am Annette with First American Home Warranty and JCP. And next week, have you ever wondered what is that big stack of papers when you get your natural hazard disclosures when you're buying a home? There's a lot of information there, mainly to fire. So it's going to tell you if your property is in a high risk zone to fire, earthquake, liquefaction, all kinds of different things. It's going to give you the tax information, and then if there's a PG&E a gas pipeline near you. So it's a very important document packet that you get. So I'm going to go over that with you next week, and also
In 2 weeks. 2 weeks.
I'm sorry, 2 weeks on the 18th. And also, is it important to have a home warranty? And can you get that when you're not in escrow? So stay tuned. I'm looking forward to talking with you all next session on the 18th.
On the 18th.
Thank you, Coco.
Thank you, Nat. Larry
welcome.
from Property Inspection Service, please give us a very quick preview of what we can look forward to.
Hi, my name's Larry Tringali. I was a real estate agent for way long time, way too long. And then the first company that ever started home inspections was this company. It started in 1980 when there was no such thing. We used to just walk around the edge of the perimeter of the property, look at the foundation, say to the buyer, I don't see any cracks in the foundation. Do you? No? Okay, I guess it's fine. Well, in 1982, someone said, this is stupid. And they started this company, which in 2012, I ended up buying. So what I am going to talk to you about is, because I've been a real estate agent for a way long time, and I know what buyers are thinking, is when you walk up into a house, you're really looking, you don't know much, and you're thinking, is there any deal killers here? You know, maybe the fence isn't right. Maybe, you know, there's light bulbs out, or, you know, little things. But the big deals, and what I'm going to talk about next week almost for
2
half
weeks.
the time is
2 weeks.
I didn't hear what you said, but I'm just going to talk quick.
Yeah.
It's the biggest expense that we find in a home that is easily preventable if you know what to look for. So from the time you get out of the car, there's key things that I want you to write down to look for so that you'll know whether this home is a good home or is there a deal killer in here somewhere that you just aren't aware of. There, that's it.
That sounds great to me. So everyone, be sure to join us in 2 weeks, August 18th, same time, 5:30 to 6:30, part 1 of our new series, Buyers, Are You Ready seminar. So now let's open up the Q&A session. I have some private messages and questions from other platform and also from private messages here. So number 1 question, what is the tax consequences of cash out refinance on a rental property to pay off other rental properties? Are the interest from the new mortgage loan fully tax deductible with the cash out? I think that's a question for Bean.
Okay, so I think that's a 2 question chained together. So first of all, is a cash refinance, are they tax deductible in the rental setting? Yes, as long as the mortgage is the mortgage loan is secured by the value, okay, on the rental house. That rental house income can offset the rental cost, the mortgage cost. But if you use the proceeds to buy another home, which is also a rental home, that proceeds should be allocated to the new rental to do the deduction. It's kind of very complicated on the accounting, but I hope the homeowner or the landlord can keep track which loan belong to what, okay? So, and IRS could deny you if you cannot prove the cash is being spent on the business, okay? So if you change hand several times before you buy the rental house, that proceeds, that mortgage may not be deductible. So,
or the cash out to pay off the other loans on the other rental properties. So that should be all tax deductible, right? If they do cash out on one rental property to pay off the other rental properties, to pay off the mortgage on the other rental properties.
Pay off the other rental, yes, but you still have the mortgage, right?
Right.
You're gonna deduct the mortgage though. I think there's a percentage allocation when you pay off that loan, some proceeds by proportion should be allocated to the one you are paying off.
Okay.
Okay, so I just said they're deductible, but just make sure you allocate it to which property to deduct.
Okay. Thank you, Vin. There's a
Yeah.
question on the Zoom. Is in a 1031 exchange, can I sell one property and buy two properties? James?
Yes, you're not even limited to two. You could buy many properties in a 1031 exchange as long as you fit within the 200% rule. We've had clients sell one, especially in the Bay Area, and go out of state or go to different parts of California and buy, you know, I've had a client buy over 50 properties in an exchange.
Okay. Actually, I missed the top. So let's go to the top. Rental property loss can carry forward indefinite or limit to certain years.
So is that to me? Okay. So
Rental property loss, can it be
can
carried
be carried-
forward? Mm.
Yeah, they carried on the form 8582, I think, forever until you sell any rental to have gain. Okay.
Okay. And then if I have a rental property and then I will move in to live for 2 years, after that, can I sell it and take the 500,000 capital gain exemption?
If you have a rental property,
I just
yes, you
in
can
for
take
living for 2 years.
500, but you also need to take in to the non-qualified use, divide by the whole time you own the house. Those are still taxable.
So basically you have to
So
look
there-
back for 5 years, right?
Not only the 5 year, they will look at all the year you using. Well, he said he rented out.
It was a rental, yeah. Mhm.
So
It was
it's
a rental.
So you need to add all the rental period after 2009. So there's some law change in the 2009 to introduce a concept called the non-qualified use. So
Okay.
if you use non-qualified, want to exempt for 500,000 121 exemption, you have to find out how long you use this property for the rental. If you use a rental, those time will not be qualified for the exemption.
Okay. And also, can the CPA please explain the expense for the rental property when the refinance happened during the tax year? Can I expense the escrow fees and the points?
For the rental, right?
Yes.
For the rental, all the closing costs and the points and the fee, they are amortizable on the length of the loan. If your loan is over 30 years, all those costs can be amortized in 1/30th every year. You know.
Okay.
So they are deductible, but very slowly. You know.
Okay. Can accumulated carry forward rental loss can be offset to the capital gain from the stock or only like kind? Does that question make sense to you?
So the question is, if he sell the rental, he has a capital gain, right?
Rental loss?
No, rental loss cannot be offset any gain, except your earning is under 100K, right?
Can you offset to the capital gain from the stock or
Of
only
course
the
not.
like kind?
No.
Yeah.
No,
No.
they are not passive. You know, they
Okay.
are not the capital loss. Only the capital loss and the capital gain can offset the capital loss.
Okay. For the 1031 exchange, if only partial capital gain was used for the exchange, the tax will be assessed on owning the unused capital gain, correct?
Yeah, in a partial exchange where you buy of less value or keep some of the cash, which we call boot, only that portion is taxed, but you'll still be in a position to defer the other portion of the gain. As long as you buy above your cost basis, you'll still be in a position to defer some of the tax, even if you buy of less value.
Okay. For tax purposes, how is the 2 years of residence out of the past 5 years generally documented? What is the required for documentation for tax purposes?
So normally you should document just like you document for your public school record. Okay, if you want to go to public school, the school district will ask you for the PG&E bill, the other kind of bill, and to prove you are live there. your voting records, your DMV records probably will show you how you lived over there, you know. So
Sounds great. Yeah.
in anytime IRS challenge you, you should be able to provide those.
Okay. And then this one's for James. Oh, actually, let me see. Is there a certain agent fee for 1031 exchange, similar to like real estate agent fee?
Well, there's a fee, but it's not similar to a real estate agent fee. Unfortunately, ours is a lot less. The typical fee is about $850 for the property being sold and $250 for each property being acquired. So not a percentage, just a flat rate. Very reasonable for properties in the Bay Area, especially.
Okay, thank you. And there is a question, if the total rental, if the rental is a loss, can I get 20% exemption for one of the rental properties which has income?
No, I understand what's the, so if you want to take a 199 cap A deduction, you have to do the net, just like you do for the stock, okay? So you need a net together, all the gain against all the loss to see you have a net gain on net loss. The capital A only allowed to get 20% deduction on when you have a net gain, but you still need to calculate the net loss. All those loss should be carried over to the future year to against all your gain, okay? So you cannot cherry picking which one should be gain, I get the 20%. For the loss, I get the deduction anyway, you know, then you were not taking into account for. So IRS wants you net the gain with all the loss, then you get the 20%. You know.
Okay. So there's another question. Can Beam please explain the tax implication, like gift tax, when a child is added to the title of a house where the parents own? And when the household is sold later, does it qualify for 750,000 capital gain exemption because now we have parents and the child, the grown-up child?
No, I don't think the rule work like that way. So the first one they said about the gift. Okay, if a parents, sounds like parents add the children's name to the title.
Right.
So either through the grantee or quit claim deed, it's create a gift. Okay, so the parents should report on the gift return to report the fair market value, how much the gift. Okay, so the gift very easy to skip tax right now because the gift limit is also 11 million. So when they I think the rule says, I think it says if they live, everyone in there, 3 person lived in there, they can get $750,000 million exemption. Is that what they try?
Yes.
Try to do?
Yes.
No, IRS doesn't allow this. Every house only a $250,000 million, $500,000 in the total. Every house cannot over a $500,000 exemption.
I see. Okay.
So I'm not sure if the kids can get $250,000 and the parents can get another $250,000. Because I know the 121 exemption probably only allow in the couple. I don't know in the intergeneration they will allow that. I don't have an answer for that yet. You know, even allowed, there's only 2 exemption. They cannot multiply by 3. You know.
Okay. So there's question, is there exchange for primary home? I can answer that one. No, you cannot exchange for primary home. The next question, actually 2 questions together. I have a rental property. Now I move to the home moving to the rental as a primary home. How long should I stay to consider the primary home to have the rental home to be considered as a primary home so I can get the 500,000 capital gain exemption? And related to this question, if I lived in a house for the first 2 years, then convert it into a rental, then I rent out for 10 years. Then I come back and leave the house in 3 years. Can I now make a 500,000 capital gain exemption? So I think probably all like what you mentioned being earlier.
I get a loss in somewhere, but I think the boils down to one question. Okay, so how can you qualify for the exemption? Normally, you need to own the house for 2 years and live there for 2 years. And that 2 years doesn't have to be consecutive. You can spread it out within 5 years as long as you added up 2 years. So he's talking about if he move in and out of the house, will he still qualify? My question is, as long as at the time when you sell, you go back 5 years, you can aggregate 2 years, you live there and treat it as your primary house, you will be qualified. But before you can take the exemption, you also need to do a very complicated calculation. And you better have a CPA to do that. So I just explain a little bit. I mentioned the unqualified use. Okay, you need to find out how long you took the house for unqualified use. Unqualified use is like you didn't live over there. The house is empty, or the house is rented out, or the house is being rebuilt or remodeled. All those is counted as an unqualified use. All those times should added up and divide by the whole period you own the house for how many years. So that percentage multiplied by your gain they always taxable. Okay.
Okay. So next
Coco,
question.
Coco,
Yeah.
I wanted to add something on that. I think it's a good point to bring up because we're in the Bay Area.
Mhm.
A lot of people have massive gains on their property and they only qualify for the $500,000 exclusion. A lot of our clients move out and rent
That's
that
right.
property for 1 to 2 years, however long BIN would recommend, and then they exchange it. They still get the entire $500,000 and they could 1031 exchange the rest. I think it's a great strategy that everybody needs to be aware of in the Bay Area.
You mean you actually can combine the exemption
Yeah.
and also the 1031 exchange?
Yes.
If you treat them as a rental, right?
Yeah. So if I was living in the property for 20 years and I had a $2 million gain, and I knew if I sold it, I could only protect 500,000, then I could theoretically move out and rent that property. Let's just say I rented for 2 years, then I sell it. I still lived in it 2 out of the last 5 years, so we could take the $500,000 and we'll 1031 exchange the remainder. So if I sold it for 2 million, I'd take 500 and exchange 1.5 million.
No, interesting. I thought we can only use either or, not both.
You can combine.
What's your
But
take?
you're right, before your exchange, you treat it as a rental, right?
Correct.
That's the key.
That's the key. You can't have it as a rental, then convert it to a primary and then do both. It has to be primary, converted to rental, rented as long as the CPA recommends, then sell. Make sure you sell it within 3 years so you live there 2 out of the last 5, and then you can take advantage of both 121 and 1031.
Okay, so but if it's a rental, then if you move in there, you cannot do that the reverse way, you're saying?
No, because like the amendment to section code 121 that Ben's referencing, you're only going to get a prorated share of protection.
Yeah.
Makes sense.
But I
That's a
think
very good
one
point.
thing you mentioned, if you rental 1031's house, you move in as your primary house, they can still get the $500,000 exemption as long after you moved in, you live there for 5 years, then you will
5
start
years.
to qualify.
Okay, 5, not 2 years.
Not only 2 years. 1031's property convert to a primary house, you need to live there for 5 years.
That was a big change in 04 because what people used to do in the past was they would sell an investment property, buy it, rent it 1 year, live in it, live there for 2 years, sell it, get the 500 exclusion, and keep on doing it. Then they said you have to own it for 5 years, and that was still fine. Then in 09, they just ruined it.
Okay.
They didn't ruin it, but they changed it. So it's
unqualified use.
Yeah, the unqualified use just changed it a lot.
Got it. Wow. Good to learn. Yeah, I have so many other questions. Let's just run through very quickly. So somebody's asking, which is the best? Do you have rental income added to your AGI, or do you want to set up a company and add a rental property to that company? I guess trying to ask what's the best in terms of saving taxes, right? What's best What's the
Are you
best?
talk about to have a rental inside the LLC to do the assets protection?
Then that's actually second question
Okay.
from another person. Do you recommend setting up LLC if you own 3 or more investment properties?
According to attorney, yes, they always recommend it.
I'd like to add something to that as well. I agree with Ben. Attorneys will always recommend it, but I've also talked to a lot of other investors, and sometimes if you just check your insurance policy, it may provide the same coverage as an LLC. And rather than paying the annual fees of an LLC, that's something you want to talk to your insurance provider and see if you have adequate coverage. You may not need to do that. I'm not saying don't do that, but ask the appropriate questions and see what's best, because an LLC will have annual fees.
Yeah, but the LLC has unlimited liability. You have limited protection. So attorney normally says you still need to buy the umbrella policy, but try to hold the house into the LLC. So if the house come down, somebody get injured over there, if you can blame on the structure, you probably only come out to pay the house. You're not gonna pay unlimited liability, So that's any insurance cannot protect you. They only have a limit. Any insurance has a limit.
That could be our next topic about setting up LLC. That's
Sure.
We're going to come back for that AGI question, the rental income. If there was no capital gain from the investment property being held, there's no point of doing 1031. Is correct? Even if I am indeed purchase another investment property after I sell
if there's no gain, maybe. If there's a lot of first off, if they exchanged into it, there may have been a gain that followed into that property. You just have to make sure that there wasn't an exchange to go into that property, because some people think, oh, I sold it for this, then I bought this, I'm selling it, and there's no gain on this property, but there was on the other one. It follows you. Number one. Number two, there may be depreciation recapture that they have to pay. So those are the two things. And Ben can answer that question when that client comes to them, if they need it or not. They should never just make that question because they're selling for the same price. There may be other factors that adjusted the basis.
Okay.
Yeah.
I have 2 more questions here. So I have an investment property under LLC. If I bought a new property with hard money loan, with the same LLC as the buyer as part of the 1031 exchange, would it trigger any taxes if I were to take the new property out of the LLC, put it under my personal name, refinance, then put it back into the LLC?
Normally, no, because that LLC is a single member LLC. It's disregarded entity, okay? So when you have a disregarded entity report on your tax return, IRS is almost transparent to it. IRS doesn't care if you own it in your person or through the LLC. They also report it on the Schedule E. Doesn't matter, But when you take out and take in the property tax, you need to watch out. You need to find the correct escrow office over there. Yeah, if you don't convert the title right, you could trigger the assess of a property tax.
You might also,
go ahead.
You could also get hit with dual transfer tax when you take it in and out of that, which is very costly. And I completely agree with Ben on the disregarded entity. But if it is and we didn't mention that on the 1031 exchange, whatever taxpayer sells is the taxpayer that needs to buy. Sometimes they look different, but they're the same, like a living trust is usually disregarded as well. But if it's an irrevocable trust and it's taxpayer ID to social security number, this is a problem. If it's LLC with a taxpayer ID and you're trying to change things after you bought your replacement property, you can't do that right away without risk. You'd have to wait as long as Ben tells you to.
Okay. I think one of the reasons they want to do that is because LLC is very hard to get financing.
Yeah, that's usually the reason.
Yeah.
Okay, for James, for the case you mentioned to combine for multi-unit property example, like 3-unit apartments, or well, the owner can live in one of the units, it's still possible to do the 1031 exchange, like a triplex or fourplex.
Yeah, that's where you would combine both section codes again. You're going to be living in one of the units. That portion will qualify for the exclusion if that's the way you've treated it. And the other 2 units would qualify for the 1031 exchange. So in that example, when you sell the asset, you'll get your exclusion money and you'll 1031 exchange the rest. And sometimes that's on the CPA again to determine what those percentages are, because even though it's a 3-unit building, we all know that maybe it's the 3 and 2 unit that they're living in, and the other ones are 2 and 1s, and they're different values. And it's not all the same percentage. So that again will go on the CPA, but I would let them know that in a conversation.
Okay,
I just
good.
give Ben all my clients to answer all the questions.
Exactly. Refer to the CPA, right? That's
have to,
exactly
have
the
to.
answer.
He does the taxes. He knows their history. Can't be us.
Yeah. Okay, so there's a question that basically for me, where do I see the Bay Area real estate market in the next few years, knowing Facebook and many other high-tech companies let the employees working from home forever. So I think that's going to be our next topic. We're going to talk about that as well. If I buy a second home or put it on rent, if I buy a second home and put it on rent, does it become to be rental property? I think yes, right? That's if you put on rent.
Well, there's second homes don't qualify for a 1031 exchange, but if you start to Airbnb it and start to get rent out of it, as long as you don't use it more than 14 days out of the year for personal use and rent it out at least 14 days out of the year and have short-term rental agreements to show this treatment and do that for 2 consecutive years, it'll qualify for a 1031 exchange. So it's a black and white area that a lot of investors that own second homes treat very gray. They probably cross those 14 days in different ways. Again, I'll leave that up to Ben to create that paper trail for them. But it's usually 14-day rule or 10% of the time that you rent it that you can use it for personal use. But they don't typically qualify for an exchange unless you create that paper trail. Or people just do it and take a risk of not being audited, and I'd never recommend that.
Okay. How long can I avoid tax with 1031 exchange? Can I keep selling and buying rentals?
Buy till you die is the motto we have, and then get the step up in basis and have the children inherit that property and either sell it at that point without a capital gain. And the gift and estate tax limits are so high right now, most people won't even get hit with that either. So it's swap till you drop or buy till you die. That's the motto for the true investor.
Okay, there's a question, what qualifies as a second home? Actually, this ties with another question I got ahead of the seminar. It's basically saying if we own 2 homes in 2 states, one in California, one in Texas, husband and wife had to live in different states due to work. And in Texas, there's no state tax. What is the best way to report taxes in this way? And if we have to travel between those 2 states and later on sell one of the houses, which one can we report as a primary home? I guess it's also the second home ties into this question. What qualifies a second home and in terms of tax reporting being?
Okay, so normally the 750 or $1 million, it's not only cover your primary home, it's also combined with your second home, okay? So you could put a 2 house as long as the loan aggregated together not over $1 million or after 2017, over 750. So you will get both house get the deduction, okay? And on the property tax, now in the old days, no matter how many property tax you pay, they are deductible as long as you don't trigger AMT. But right now, federal only can allow you to deduct $10,000. So in the case you describe, if you have a California house and a Texas house, I would say both are tax deductible as long as the aggregated loan is not over 750. Okay. And the property tax is also aggregated deductible as long as it don't over $10,000. You know.
Okay. So does the second home need to be in a certain distance away from your current residence?
That's only in the tax law. We don't differentiate this.
I think it's money in the lending.
When you buy the house in the real estate, you guys have 50 miles rule, right?
Yeah, it's in lending.
50 miles, then you treat it as a second house.
Yeah,
you know?
It's more for interest rate, I think, in that case.
Yeah. Only when you buy in the loan, on the loan office check that. In the tax law, they can allow you to have a second in the neighbor.
Okay.
You know? Yeah.
You just mentioned AMT. I have a question, a private message saying, if I sell my stocks that worth about $3 million, would that trigger AMT taxes?
Probably they will.
Okay.
That's over $1 million. You still very likely to pay the AMT, you know.
Okay, and there's another private question. Proposition 39 for higher income tax rate and
Right.
highly appreciate asset sale. Can you just comment on that one?
So proposition, I think it's proposition 30
30.
is being enacted after 2012. California, the richest California start to paying 10.3%, 11.3, and the 12.3. You know, so those the highest tax rate is going up. You know, so if you make $1 million every year in California, you could pay like 13.3. You know, so I don't know if they're gonna back down. You know, the FTB, California Tax Bureau, will change that. You know, in the proposal many years ago, I remember they said only do a couple years, maybe 10 years, until they solve the fiscal crisis.
They're not going to change it.
I don't think they're gonna go down. As soon as they spend the money, they like to tax. Yeah, I heard something like the 47% the richest, the 47% of California tax is being paid by the 5% earner. You know, the top 5% earner, probably living in the Bay Area and Hollywood. You know, so I don't think they're gonna going down very soon. So, and your another question is about highly appreciated assets, right? Highly appreciated assets. If you have a rental property being highly appreciated, the quickest way to defer the tax is 1031, right, James? You know.
That's what I would recommend.
Yeah. So, and although nowadays there's some new things called a qualified opportunity zone. Okay, so you can only defer the gain, not the principal, but you have to invest in distressed place. You know.
And there's only
the property.
there's
like
not many distressed places, and there's a lot of things you have to do in order to comply. But yeah, it is an option.
Yeah, there's option after the Trump tax reform.
Yeah.
So, Coco is still there? Yeah, I think that's all the question I saw.
I don't see anything else on the chat. I think.
Yeah. Okay.
I don't know. I think we lost Coco.
Lost Coco. Okay.
The only other question I saw was the real estate market with tech allowing people to stay home. I can comment to that a little bit. We've seen a significant drop in office transactions in the Bay Area, office retail, and hospitality, all as a result of COVID-19. And I think it gave a little bit of a realization that we may not need to pay these high dollar amounts to stay in these office buildings in the future. It's going to be very interesting to see after COVID-19 how it's going to recover both hospitality and office in particular, especially where they charge such high prices in the Bay Area. It'll be an interesting future.
Yeah. And okay, since we're waiting for the Coco to come online, Coco want me to if there's anything related to the COVID virus related to tax relief. So I prepared one slide for her. Let me see. So on this slide, basically, COVID-19, there's a CARE Act enacted, okay? So on the CARE Act, let me just show my slide over here. So in the CARE Act, about if you suffer the loss, there's a carryover allowed for 2018 and the 19 and the 20. You can carry back loss for 5 years now. In the Trump's tax reform, they are suspended, okay? And also one thing, I think another thing is for the commercial real estate and the qualified improvement property, you can qualify for the bonus depreciation again. In the Trump's tax act, they suspended, means you cannot do the office remodel and deduct everything. But right now they allowed it. And another thing maybe related, James, this relate to you, but it's already passed. So for 45 days waiting and identify the 1031 property, if they follow in between April 15th to July 15th.
April 1st.
Yeah, April. So they are extended to July 15th, although July 15th already passed.
Yeah, I was going to talk about that, but you and I both know it doesn't exist anymore. But people ask every day if there's going to be another extension.
Yeah, maybe it could
Maybe. I doubt it, to be honest.
And the other two for the employee in the real estate, no matter you do the real estate development or the commercial, so the employee has a retention credit for 5,000 per employee being retained, and the PPP are still going on, so you can apply for the PPP check protection, so those things.
No, I just wanted to answer a question that was out there. If siblings want to do an exchange and they buy one property together, that is possible. It's all about timing. You want to make sure that the both relinquished properties are selling very closely to each other so they can combine to buy something together. That happens quite often where there's two different buyers buying a property. In a 1031 exchange, it's more challenging because you have these timeframes that you have to adhere to. Another property, about selling a property internationally. Can you buy it in the United States? The answer is no, but international exchanges can buy internationally. So if I were to sell in China and want to buy in China, that does work. IPX does not do international trades because of the currency, but I do know an organization that does. So if you want, just contact me. But domestic for domestic, international for an international qualifies. People quite often ask me, how come I can't sell in the United States and buy, for example, in Canada? Well, because then Uncle Sam is not going to get paid at some point, and that's just the real truth to that. So it will never happen. I don't believe so. U.S. territories, most of them qualify.
I got kicked out for a little bit.
James, I ask you a question. Do you do China? If my client sell the house in China, they have a lot of gain. Can they give the money?
No, we can't do it because we don't do the currency. But I can give you a referral source of somebody that does international.
Oh, really?
Trades. Yeah.
There is somebody can do that.
Yeah, okay. There is.
All right.
That's nice. Yeah. Okay. So I think we have a lot more questions here, but do we have? We actually seriously over our time now. So what do we do? Do we?
I think that's only one last question we haven't answered over here. Somebody have a 1.5 million I saw, and he cashback refinance to 2 million. He want to ask, can he still deduct 1 million or the 750? So the answer is still 1 million,
Okay, and there's also a question, well, I'm not sure you covered or not because I got kicked out for a little bit by my internet. So what's the rule for second home from real estate perspective? Does it impact financing? Or does it impact, I guess from tax perspective, what's the impact? I guess they're asking about the impact for the second home or financing.
I think it's the financing on the tax wise, as long as the first house and the second house not over 750K, you are fine.
Okay, second home, just basically if it qualifies as a second home, then you get pretty much similar interest rate as your primary home. But if it doesn't qualify due to the distance or whatever reason, the underwriter does not believe it's a second home, think it's a rental home, then they have to be counter offer you as a rental property. Yeah.
Yeah. Okay.
Yeah. I've done both. The second home rates are not as good as a primary, but they're pretty close and they're not as bad as investment property. And the rates just right now are fantastic, to be honest. I've never heard of them being this low.
And actually, I have learned some lenders can actually offer very close interest rate to as if it's primary home rate if you put 50% down for your rental purchase. So that's a good way to. You mute, John. Okay, so do you have any more questions? I can't really log in from my iPad here, so anybody can read the questions on the Zoom.
I only request somebody requests me to show the CR form code. You know.
Oh, there was there's a question here for you, Ben. I think they put an ADU in their primary home. How does it impact property taxes and personal taxes?
ADU is attached unit. Is that right?
Accessory, yeah, it's like an
Additional
additional
dwelling unit.
It will treat it as a improvement. Okay, so if you borrow the money to build the ADU, your loan could be deductible, but the overall loan cannot be over 750K if you building now. You know.
And then from property tax perspective, my understanding is the county will probably do a reassessment, and then you probably will. It depends on which assessor you look into, but assessors always tell us they will reassess the property. But sometimes
I can't imagine they wouldn't reassess it with an improvement like that. You'd be one lucky person to get away with that, but I'm not certain.
Yeah. So the answer is they are all tax deductible. Okay. So no matter you borrowing the loan or you pay higher property tax, they're potentially all deductible.
Okay. What's the distance rule for second home? That's only, the distance rule is only for financings, not for taxes, basically. That's, Okay. I think that's all we have. And Bing, you covered the Proposition 30 and highly appreciate asset sales, right? Because at that moment, I got dropped out.
Yeah, I heard, you know, so we recommend that he can do 1031. Although there are some other we can do, but, you know, the topic today is a 1031 exchange. Yeah.
We briefly mentioned opportunity zones, which is a good option for the right client, and you can apply it to other capital assets as well. But I think for the majority of the people on the call, and just in general, it's a lot of work and a lot of speculation that most people, when they sell real estate, don't use it as an option.
Yeah.
Okay. Yeah.
If I ask the county to reassess my property, is there any way to get the value reduced? Yeah, so you actually can. There is temporary proposition, I think it's Proposition 8, right? So you can actually try to get a tax relief. It's temporary tax relief.
Okay.
So that's what it is. But you have to do it every year. You have to, Being I cannot see the chats anymore with your sharing. I have to see the.
So, Coco, I saw somebody want our firm's CR code. We have a WeChat group over there. So if somebody wants to scan it, let me know. We help answer the question over there too. You know.
There's no other question. There's just a thank you there, I think.
Okay.
I didn't see anything else.
Thank you for letting me know. Yeah, great. Yeah.
Right.
Thank you everyone for joining us today. I look for, and thank you, Bing, thank you, James, for sharing your very valuable knowledge here. And we look forward for everyone to join back us again on August 18th, 5:30 to 6:30. Today we actually over for almost half an hour. I think it's a hot topic. So we'll start our buyer series. Buyers, are you ready? Thank you so much. We'll look forward to seeing you again soon.
Thank you, Coco.
Thank you, Coco.
Bye-bye.
Bye-bye. Bye.
Bye-bye.